Hi, everyone. Welcome back to another class here at the Normalized Money Show. I have co-host Julie on. Julie, how are you?
Very good. Excited to be here today.
We're excited to have you and talk about this simple interest made simple. So if you are listening right now and watching your screen, you're going to see a very simple Word document. And what we're going to take, 10 minutes talking about is how to calculate simple interest and the dollars around why your credit score matters. And so let's just jump right into this very simple example that you see on your screen. And what we're showing you here is that a 740 credit score. Let's talk about if you were to get a $20,000 loan at 6%, because that is probably give or take what the interest rate would be on maybe a car loan. And they may or may not do a simple interest for you for a period of time if they maybe have some kind of a deal. But for the purpose of this example, let's take $20,000. You can do it on your cell phone if you would like to, or with any basic calculator, not a complicated calculator, just a basic calculator. You put in $20,000 times 6% equals 1,200. And then you would divide that by 12 months in a year. And your monthly payment would be $100. So this is an estimated interest rate of 6% with a 740 credit score. Now let's compare that to a 680 credit score. Now remember that in one of our previous episodes, we talked about what is a good credit score and 3 secrets from the bank or an underwriter, which was me, and how we would look at rate sheets based on people's credit scores, and that determines somebody's interest rate. And so if we have someone with a 680 credit score and we look at the rate sheet and it says 10%, let's calculate that using a simple calculator, your cell phone. $20,000 or just 20,000 times 10% equals $2,000 per month, or I'm sorry, per year. And now you need to divide that by 12 months, and your payment goes up to $166.67 per month. So you can see here that now it is costing you $66 essentially per month because your credit score was 680 and not 740. Julie, what are your thoughts on this?
So I want to go back and remind, maybe somebody didn't see the previous episode, but the credit scores will go from higher is better. So the higher the number, the better the credit that you have shown. So when we're looking at this and we're saying, okay, 740, that's not quite the highest number you can get, correct?
Correct. However, most banks are going to think anything 740 and above, that's your best pricing bracket. Normally there's not another price bracket. Maybe it's 760, but generally speaking 740 is going to
Okay,
be.
so the 740 at the highest is what I'm kind of going to aim for, because I want to have the lowest payment each month, because essentially I'm using other people's money for the time being to spread out my need, right? We talk about this, it might be a car, this might be something that, their expenses call for, that it's a must, it's a need, right? So if I'm only having to pay $100 a month as compared to $166 a month, that's quite a bit of savings over 12 months, right? Because we're times now $66 for 12 months that I'm paying extra for. So
Yeah, it's $800 difference per year and, $66 per month. And what we're trying to touch on here for all the listeners is that your credit score matters. And also, Julie and I just talked about this before we jumped on the show, is borrowing money is perfectly fine. And if anyone tells you differently, I'm not sure if they have a ton of money, so they just use cash to get ahead, or if they're scared to borrow money. But borrowing money has been the way of the United States for hundreds of years, because when you need to start a business, a lot of times you'll need a little bit of capital, so maybe $2,000. And it becomes hard to save $2,000. And so you might go to the bank and you might say, I would like to start a business. Here's my business plan. And if you could please loan me $2,000, I only make $10 or $15 an hour if you're just getting started out in life. Minimum wage right now, I think it's $14.25 is where it's at for the United States right now. You'll have to look that up. Don't quote me on that, but I think that's where we're at. But the point is this: to pay your rent right now is probably going to cost right in there, plus food and utilities. So going to borrow money is not bad. Having a good credit score is what's very important, and making sure that you know how to budget and pay your monthly payment every single month. That's what's important. It's called ability to repay. It actually has a term. ATR is what we call it at the bank, ability to repay. And so if somebody can show their ability to repay, we happily will give them money, because we want them to pay 6% interest or 10% interest. Or if we go down here to the 620 credit score, somebody who maybe has zero credit, so they don't have bad credit, they just don't have anything. When we pull their credit report using their social security number and their name, their legal name, and their date of birth and their address where they've lived for 2 years, that's going to give us a report. And if they have nothing on it, they probably are going to be in the 620 credit score range. And maybe you end up getting a 17% interest rate because you have no established credit with the bank. And so if we look at that payment on $20,000, just again, go to your cell phone, 20,000 times 17%, divide, that comes out to 3,400 for the year. You divide that by 12 months. Your payment now is $283.34 per month. That is considerably higher than if you have a 680 credit score and your payment is $166 per month. Julie, what are your thoughts?
Well, the difference between the 740 credit score and the 620 is, obviously more than 100 on the credit score, but on the money wise, you're paying $2,200 more for that same item that somebody else paid for. So if you look at it that way, if it's, again, you talked a little bit about budgeting, you talked about knowing what you owe and people being scared to loan money. I think that the core reason why they're afraid to loan the money is because they're afraid that they won't be able to pay it back. And I think, we can talk about this on some episodes later on about, different tools that the banks may have for lending and what's better. And we're talking right now about simple interest. And sometimes your average, that you pay for interest makes a big difference for your budgets and how you pay things off and how you're using your money. So I think when it comes to our credit scores and knowing that our credit scores are important and there are different ways that we can make them higher by making smarter decisions, this starts with it, right? Because if I went there and said, okay, my credit score is 620 and I'm paying $2,000 more for something that somebody else that has a better credit score, am I going to be able to afford that $283 payment or not? I can definitely afford the $100 payment, right? But I can't necessarily afford that $283. And I think, being younger, starting over, this is where you have to really make sure that you're hitting some of these points that we talk about on the other videos to get that score up.
Definitely. And you have to start somewhere. Julie, I just want to mention, when you were touching on a few things there, I thought I heard you say maybe people are nervous to lend money versus borrow money. And that could be true depending on what lenders you're working with. And so you might go to some lenders who naturally give you a higher interest rate because that's where they're comfortable lending money. Julie, you had previously talked about you like to deal with credit unions, and they normally have pretty competitive interest rates. And so going to 3 different banks, or if it's a car situation, maybe you check with 3 different dealerships, letting someone run your credit, a reputable company, because you're giving them your social security number and your date of birth and your full legal name and your address. That's, personal information. So going to a credit union would be a very good place to start. A bank that's been established for quite a while in your town, and sitting with someone in their office and saying, can you please run my credit? And then they might come back with a certain rate, and maybe you want to go down the street and talk to a banker at Chase Bank, and then maybe you want to go and talk to someone at Citibank. Coming from underwriting, I will tell you 3, you don't want to start doing more than 3, but that is good in general, just to kind of see where the banks are at and if they want your business or if they're running any specials. Maybe like me, I prefer to go to enterprise car sales or even some of the big dealerships, and I check in with them because they will run 0% interest rate specials, especially around holidays or the year-end closeout deals where you don't pay any interest whatsoever. And so then, of course, you would just take $20,000 and you would just divide that, by the number of months. So if that was a 5-year car loan, that would be 60 months. And so your payment would be $333, except for now we're getting into something different, which is actually paying off the car and paying principal. So that's a different kind of calculation, guys. Don't get confused. What we're talking about on the screen is just interest. These are just paying the interest. But the important thing here is that the credit scores are going to determine if you can get a 0% loan or a 6%, 10%, 17%. And you should not be scared to go and ask for a loan. What you should be scared of is not knowing what your budget is. We'll get into that conversation later.
Yeah, I mean, there's one more click in there when you say what you should be scared of is the urgency that you're giving yourself that you need that item, and that accepting any payment that they give you. So, like you said, they're not the underwriters. They're not on the other side of that table. And I've been there where it's like, okay, we're going to run your credit with different banks and we're going to give you an option, and they give you like 3 different options, or maybe they only give you one and they tell you this is the only bank that'll approve you. And if that price isn't the price that you decided before you get there, that you have to like really say, I have to think about this, because their job is to sell that car or that item to you right there. So we want to make sure that you understand that you're not getting into something that you can't necessarily pay for or get out of.
Really great point is that you should always take 24 hours to think about it. Maybe go home and then go back the next day. They will normally hold any type of offer for 3 days at a bank or a lender. They do want your business. You probably don't want to go shop on the 31st day of the month. I would recommend going on the 28th or the 29th if there's a deal going. That way you can walk away, take some time, make sure you can afford the payment long term, and then you can go back the next day and sign the paperwork. So, Julie, that's all that I have. Do you have anything else?
I think this is a great illustration showing what your credit score and how much you're going to pay. If you find value in our content, like and subscribe, and come back next week for our next lesson.